the only central bank that is still short gold and silver is an extremely wrong-footed Fed. However, it was official defense in silver futures that really gave away the scale of global physical supply shortages in physical silver. Geopolitical drivers, along with geological constraints to meet physical demand for immediate delivery, suggest gold is undervalued at $5,000. In fact, as we'd assessed last week, a growing number of bullion banks are now joining Goldman's plus or minus 5,000 target, with Hartnett last Friday assessing 6,000.
The cracks in the paper precious metals market are now impossible to ignore. What began as minor discrepancies between futures and spot prices has evolved into a full-blown structural failure within the Comex system. The supposed price discovery mechanism for silver is no longer functioning. Futures are deeply mispriced, detached from the actual physical demand that is now centered in Asia. Lease rates for silver have spiked to record highs, over 30%, and backwardations stretch out for years ahead, signaling an unprecedented breakdown in market equilibrium. The paper market is cracking under the weight of real-world shortages. Andrew Maguire, veteran precious metals trader and whistleblower, explains that physical silver demand from Eastern markets has overwhelmed Western price controls. With the Shanghai Gold Exchange leading settlement activity, Comex is no longer setting the tone. It's reacting. As Maguire notes, the Fed remains the only central bank still short both gold and silver, exposing its fragile position in a world shifting to physical settlement and real price discovery. Now, we present the clips from Andrew Maguire's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
So the unallocated cash settlement process had continued and continued. And we have delved into far more granular look at how these ballooning undeliverable liabilities began to be called upon by the Asian-facing physical settlement markets, jumping the LBMA ring fence into Chinese physically settled exchanges. Now, don't get me wrong. These four banks are not stupid. Each of them are long both gold and silver for their own books, very long for their own books. However, having a footprint in the spot, Comex, and the Western-facing Shanghai Gold Exchange international markets, the international-facing markets, it's enabled them to continue to stick handle these ever deeper, leveraged underwater bets, which are captured in the quarterly Office of the Comptroller, the OCC report. And it exposes the only central bank that is still short gold and silver is an extremely wrong-footed Fed. However, it was official defense in silver futures that really gave away the scale of global physical supply shortages in physical silver. Now, while both sets of automated gold and silver future spec rinses constructively serve to restore upside physical support equilibrium, these staging points, the ballooning EFP basis spreads, in other words, the spread between the deeply undervalued Comex futures markets and the much higher priced spot deliverable markets, further exposes Comex silver is now acting as a price taker and is most definitely being targeted for another backdoor loadout. Now, by last Friday's London Open, lease rates to borrow silver to meet immediate delivery demand spiked way north of 24%. We're using 24%, but it was actually over 30%, driving the silver short squeeze EFP basis spreads that we just talked about. And here we captured it here live at a huge $2.80. That's $14,000 per contract difference. In fact, it has been as high as $3 or $15,000 per contract. Now, the expanded basis spread misplaces the spot equivalent fix. So to illustrate, we spot adjust it in and demonstrate it in green at the fix hours. And as you can see, it is substantially higher than the Comex, where we actually place the equivalent Comex fix. At the peak, we captured these unprecedented futures backwardations extending all the way through to July 2028. This is mind-boggling. It's unprecedented. It illustrated mispricing Comex silver market futures are completely broken. The market's broken. Whereas in real time, we're evidencing the SGE-centric, physically settled global spot markets shaking this Comex tail. It's amazing to me that how few people have actually woken up to this huge breaking of the Comex.
The breakdown of London's control over the global silver market is now undeniable. The once dominant pricing hub is struggling under the weight of physical shortages and soaring lease rates, signaling a loss of trust among market participants. Despite the illusion of sufficient Comex inventory, the reality is that much of it is leveraged, rehypothecated, and poorly backed by actual physical supply. The supposed arbitrage opportunities between US and London prices are vanishing, with logistical delays and delivery hesitations revealing just how thin the market truly is. While the paper price of silver remains suppressed, physical silver is trading at record highs across nearly every primary currency. The LBMA's race to cover unallocated obligations by flying metal across the Atlantic is only delaying an inevitable reckoning, one that will end with physical price discovery prevailing. Let's get back to the interview.
London has lost control of the global silver market. We said it last time. It is now so clear it's hard to ignore. Unprecedentedly high risk, unfulfilled local London lease fees illustrate both a lack of trust to lend metal into global supply tightness. So, why you can't trust it. It's too risky. These spreads could be closed at any time. And while registered Comex inventories appear to be in adequate supply, that is enough to cover a rush of delivery demands, really, as it looks at face value, these leveraged CME warehouse receipts are inequitably hedged against an unfactored lack of local London supply. This is why US lower-priced US-denominated bullion is slow to be shipped out to capitalize on up to a massively, as I say, attractive $15,000 profit per contract. Silver actually should have immediately been flown out last Thursday, last Friday. 160 SI lots would equal 25 tons. You could put those in on a plane for a matter of a few extra cents per ounce. Yet it was very slow to move. And this is really what we're drawing attention to. And while we're evidencing some profiting from shipping US bars to London, and we'll look at why this will not lower the higher spot price to meet the lower futures price. In fact, the opposite is going to happen. So minor short-term volatility aside, it's the record high global spot prices in every single other foreign exchange currency, no matter which one you look at, across the board. Spot silver is at record highs, unlike protected or capped US-centric futures silver. It's so obvious. It's mind-boggling and yet we listen to Main Street here. I'm on Bloomberg all the time. While they are caught onto gold, they have no idea that the silver market's broken and how undervalued dollar silver is. And that reflects what it is doing is reflecting really the supply shortages with this effect forcing the US silver prices much, much, much higher. The US is the sole outlier and is being targeted. And while the LBMA clearing members are facing default and are really racing to fly out what little silver bullion they can from the Comex registered and eligible stocks into London, this is largely serving to satisfy immediate, unallocated, over-the-counter bets that have been called for delivery into empty local London vaults. It's just really trying to keep pace with an immediate default. Notably, illustrating it takes higher prices to bring silver to market. So it's evident. This basis EFP spread and lease costs, they expand significantly into lower prices. They contract into higher prices, but literally expand significantly into lower prices.
The silver market is entering a phase that will redefine how value is measured across the global financial system. What's unfolding isn't just a price distortion. It's the visible breakdown of an artificial structure built on leverage, paper promises, and systemic denial. Each day that silver trades at record highs globally, yet remains capped in dollar terms, the imbalance grows sharper and more dangerous. This is the transition from trust in institutions to trust in tangible assets. As silver tightens and gold surges, the market is exposing who truly holds wealth, those with tangible assets, not paper claims. These are the quiet signals of a monetary reset already underway. Stay focused, stay grounded in fundamentals, and protect what's real before the repricing begins. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.